Now, outside of your retirement accounts, you have two different ways that you can start investing. What I like to call passive investing and what I like to call active investing. See, when most people think about investing their money, they think, how do I find the next Amazon? Or how do I find the next Microsoft before it becomes the next big thing? But for the vast majority of people, that's not how you should be investing, and that's not how you need to be investing, even if you want to be a millionaire investor. There are ways for you to create automatic passive investments that don't take much or any time on your end, that are just simple things that you set up, and now you don't have to worry about it, and you're getting exposure to the market. Because what we've seen happen over the last century is that the stock market has grown by an average of 7 to 10% a year. That doesn't mean that the stock market always goes up by 7 to 10% a year. That means on average, over the long run, that's how much the stock market has grown by. Now, the problem is most people who try to invest their money in the stock market end up losing money, which doesn't really make much sense. The stock market is growing by 7 to 10% a year, and most people are losing money in the market. What's going on here? Well, when most people try to actually make money in the market, they're trying to find the next hot stock, and they don't know how to research a company. They end up overpaying for the company, and then they sell this investment for a big loss, or they just have no idea what they're doing. Versus if you just put your money into the market and get a broader exposure to the market, it's an easier way for you to invest because you don't have to individually research each company, and they can be completely passive and automatic on your side. How does this work? Well, instead of investing in individual companies, you can invest in a fund. There's a few different types of funds. You have index funds, mutual funds, and ETFs. Index funds, mutual funds, and ETFs are three different types of funds that give you exposure not to one company, but to a basket of companies. So what that means now is you're investing into a fund that is managed by something else, either a computer or a person that will then make sure that your investment portfolio is working to give you exposure to the investments that you thought that you were getting. So what does that mean? Well, you can invest into the total stock market. There are funds that give you exposure to the total stock market. There are funds that give you exposure to the largest 500 companies in the stock market. This is called the S&P 500. There are funds that give you exposure to tech stocks. There are funds that give you exposure to healthcare stocks. There are funds that give you exposure to real estate companies. So now you can start thinking, what do I want exposure to? Do I just want exposure to the broad stock market? Do I want exposure to the largest companies in the stock market? Do I want exposure to a particular sector? Once you know that, now you can just find the right fund that will give you that exposure. Now, the big difference between something like an index fund and a mutual fund are the fees, because the fees are going to depend on how much work is required to manage the fund. Index funds are generally passively managed versus mutual funds are generally actively managed. What that means is actively managed funds are managed by a person. Passively managed funds, because they're managed by a computer, are much lower fees, meaning much cheaper to invest in than an actively managed fund, because now you're trying to bet that this person who charges a higher fee will now get better returns. Now, what we've seen happen throughout the last number of decades is that generally over the long term, this money manager cannot outperform the passively managed funds that are giving you exposure to the market once you factor in the fees. So sometimes these fees will be worth it, most of the times not. ETFs, on the other hand, can be either passively managed or actively managed, but the biggest difference between an ETF and an index fund or a mutual fund is how easily you can access an ETF, because ETFs trade just like any other stock. You can buy and sell a stock within the same second or within the same minute, versus most index funds and mutual funds you cannot. Most mutual funds and index funds have other restrictions, like limitations on how much money you have to invest. Some might require $2,000 to start investing into either one of these. They might have limits to how often you can trade them. You might only be able to buy it or sell it once in a day. ETFs, on the other hand, don't have those restrictions. You can buy or sell an ETF whenever you want, as long as the market is open. A couple examples, something like VTI. This is an ETF created by an investment institution called Vanguard, which gives you exposure to the entire stock market. So when you invest in VTI, you're investing in the total stock market. Another one would be something like SPY. Now, as a little bit of a disclaimer, while I'm giving you these as examples, I'm not telling you what to invest in. You need to do your own research, because one, investing has risks, and two, you are never guaranteed to make money when you invest. You might even lose money, which is why you need to do your own due diligence and never blindly trust a random guy on YouTube. SPY is another ETF that gives you exposure to the S&P 500. The S&P 500 are the largest 500 companies in the stock market. You can invest in an ETF like DIA. DIA is an ETF that gives you exposure to the Dow Jones. You might have heard of the Dow Jones. Well, if you invest in DIA, now you're investing in the Dow Jones. You can also invest in an ETF like QQQ. QQQ is an ETF that gives you exposure to the NASDAQ. So now these are different types of ETFs that give exposure to different indexes, and there are so many different ETFs out there. You just have to figure out first what it is that you want to invest in, then see the different options that there are. The easiest way to do that is just to do a quick Google search. There are a lot of different options out there. This is not even close to a comprehensive list, but it's a way for you to start thinking about what it is that you want to invest in. Now, when we talk about creating an automatic passive investment, what you can do is say, all right, I want to take a piece or all of this investment portfolio that I have, and now I want it to be automatically invested into my passive investments. This is where now you have to decide how involved you want to be with your investments. Do you just want to invest your money and not have to think about it? Well, then maybe you invest all of this money into your passive investments. If you want to be more involved with your money, maybe you don't do any passive investing, or maybe it's a hybrid. Me personally, I invest my money in 5 places. I invest my money into my own businesses and startups that I invest in. I invest my money into physical real estate. I invest my money into stocks. I invest some money into crypto, and I invest some money into physical gold. When it comes to my stock market investments, I have my passive investments, like we just talked about, and I also have my active investments, which we're going to talk about in just a second. So you got to decide, what do you want to invest in and how do you want to invest in it. In these passive investments, it can be completely passive and automatic, but the key here for you to succeed as a passive investor is you want to be investing for the long term, the next number of decades, not just the next number of years or the next number of months. Passive investing is a long-term game. That's where you're going to see the real wealth, and the way that you win is every week or every 2 weeks or at least every month. You want to be consistently, passively, and automatically investing your money into the markets. There are brokerages out there that will automate the whole thing for you, that are free of charge, that will allow you to invest your money into your passive investments, and they will do it without you having to manually do it. It's completely passive, so you turn it on and it will happen by itself. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.